just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts on the show today. First of all, we have independent market expert Shahina Mukadam. She's running a little late. Vinit Bolinjkar of Ventura Securities joins me right now. And Chintan Vora of Finance.com joins me on the show right now. So that's the guest list that we have for now. Today on Hot Money, we'll discuss stocks like REC and PFC, which were rallying yesterday but have managed to cool off in trade today. We talk about the retail space. Lots of news coming in terms of, some foreign companies investing in retail assets in India. We talk about a top investment bank, a counter that, our guest will buy at current market price and probably hold it for the next few years. And we discuss RBL Bank. The counter has been on a tear recently. We'll ask our guest why they believe that, RBL is moving the way it is moving over the past few days. But that's the view that we are having it at this point of time. Let's move in straight and discuss the stocks. The first stock that we want to talk about is REC and PFC. Now, ahead of the court verdict that came in yesterday, both these counters rallied 7 to 8%. Now, the verdict went against some of the power developers, and that's why power finance stocks are under pressure, both of them correcting from the highs of the day. Hasn't corrected as much as, the gain was yesterday, but so we're asking them, is it a good time to start getting into these counters? We'll ask our guest. So, Chintan, any view on REC and PFC? They've corrected significantly from the highs. Is there any immediate trigger that you see that, someone should go ahead or they should avoid REC and PFC totally?
So, I have my views split into two different parts. Sure. On a mid to short term period, we would ideally suggest that not to venture into this particular stocks because it will not show a lot of uptick, not a lot of run up. The stocks have been trading at probably, 60% kind of the prices of the 52-week high. But overall, as a sector, if you look at, power sector, it's been under a lot of tremendous pressure. The projects are not taking off. The reason being very simple, the cost of land acquisition, the problems, the regulatory glitches which it faces is enormously, higher than what we expect in the other sectors. Now, very rightly, Allahabad High Court has identified that there could be an extension in terms of reforming their entire, bad loans or whatsoever we call it. So the entire sector is sitting on 1.8 crores of stress assets. 70,000 crores of the same stress assets happens to be a completely NPAs, kind of an NPAs. So what happens is that, despite a respite coming in that everything can be dealt with NCLT, the core problem with NCLT is going to be that despite we saying that, NCLT will help them get into the recovery mode very fast, but the haircut is going to be very high in terms of the recovery. So the recovery is going to be little slower on the pace, and which is we feel that all this might have got provision. The NPS would have got provision in their books. So any reforms which will come in, any recoveries which will come in will only improve the asset quality of the underlying counter. So on a long term, again, as I will only repeat that we find these stocks to be really good. But on a short term, the momentum was only, a kind of a spurt that we see. Okay,
Vinit, what did you make of the decision that came out, and what do you make of these two stocks?
So I think, as he has pointed out, that there is a very large overhang of NPAs. So in my perspective, they're a clear avoid. Okay, the matter have gone to the NCLT. Actually, the court hearing will not have a great bearing on the matter because of, out of the 17 or 18 cases, 8-9 have already been referred to the NCLT.
Okay.
So that will play it out in its own time horizon, and they'll have to take deep cuts. So I think right now this sector is a no-go for me. And we're just staying away from that.
Okay, so that's the way that's coming in. We'd open it up for discussion. Vinit, what other sectors will get impacted? Now, there are three basically sectors, because I'm talking about the court hearing that came in yesterday and this entire issue. One will be these lenders like REC, PFC. Secondly will be the banks which have lent, and third will be the power producers. Where will the impact be felt the most on this?
It will be felt with the banks only.
Okay.
The most.
And you feel that, going ahead because of this issue, the NPA levels will rise probably going ahead?
So they will rise a bit, but most of them have been kind of taken into the books due to the aggressive NPA recognition norms. So I think there will be an impact. So I think the bank stocks might sell off a bit, PSUs, again because of rising NPAs due to the power sectors. That's the story.
And Chintan, do you agree that banks as will have to take a hit now going ahead, and that will be felt in the quarters going ahead?
Okay. So certainly yes, banks are, and which is lot of, the PSUs are very much debt laden. So banks will certainly take a hit. But as I say that all these NPA provisions would have been taken into books, and there's a lot of emphasis which is getting into the stress asset management, recoveries of NPAs. So on a shorter term, so at least for another 2 quarters, we'll see that banks might take a hit. But again, it's a very reformative kind of a measure, because out of the court settlement, through NCLT appointing the right authority, will at least ensure that there is a bit of recovery on the loan terms which is coming in. So on a short term, if we see kind of a stress, on a long term it is going to be beneficial, because whatever hit was supposed to be taken, I believe is already factored in. But because of the NCLT coming into picture now, and RBI extending this for another 15 odd days, it will only improve the asset quality going forward.
Chintan, you said that in the short term you would avoid REC, PFC, but you are bullish on these counters on the long term. Tell me 1 or 2 key triggers why you believe that such a transformation will happen.
Okay. So one of the reasons, when you look at both these counters, they have been reasonably good in terms of reasonably fairly valued in terms of the PE multiples that they trade on, the book value that they trade on. The PE multiples is sub 4 for PFC. For REC it is something which is approximately at 5, and the book values which they trade, both the counters, is 0.5 and 0.6 respectively. So one, valuation wise the stocks are really good. Power as a sector has always been the power, the consumption for power is always going to be increasing. The sector is always at a crunch. So I'm sure the business model is not going to die and decay in coming few decades. Moreover, we have seen the rallies into this particular stocks.
Okay.
And when I say that they're already trading at 60% of the prices of the year high, I'm sure there's still a lot of steam left. But the respite will come once the entire the issue of NCLT, RBI getting into the picture settles down. So this is going to take at least another quarter or 2 for these particular stocks to show robust growth, and then rally up from here on.
Okay, so that's the view that we are having in Shahina. Very quickly, we were just discussing REC and PFC and the order that came in yesterday. How would you play these counters? What's your view on the court hearing that came in yesterday?
No, but I would avoid these counters as of now because I believe that they have got a very high amount of dollar debt. So the impact of the depreciation is going to have an impact on, I would believe, on their profitability, one. And second, I do think that while they are trying to address various issues in terms of the NPAs the potential NPAs that may come about in the power sector, I think that's a risk. So I would avoid it. I think with the valuation at 0.6, while not very high, for let's say PFC, it's still, I would say at this point, a bit avoidable. We can look at it at a later date.
Okay, so I think that's the view that we're getting it at this point of time. It's a consensus, avoid at least in the short term, that our guests have been speaking about. The next actually sector we want to speak about is the retail sector. Most of the counters in this sector have been buzzing. Yesterday, Shoppers Stop was trading at record highs. We've seen traction that's coming in future retail because of the news reports coming in that probably even Amazon is looking to invest in the company, and lots of other names have actually come out on the.
As I said, you don't know who would emerge a leader in the long run. And second is the fact that there are a lot of corporate action regarding stake sales and with the MNCs coming in. So within the basket, I think I would go with Trent, Shoppers Stop and V-Mart.
Okay, so we'll discuss all these 3 stocks in detail with you, but Chintan, your opening statement, you have a minute. What's your view on the retail space?
So I will go with the flow, and I will say that we are really bullish onto this particular space, purely because of the consumption story again going up and youth being the major stakeholders in the entire story. We are really bullish on the retail sector, and if there is one particular counter that I need to be targeting upon, of 2 of my favorites, one being the Avenue Supermarts and another being the Future Retail, I would rather bet my money onto Future Retail at this point in time.
Okay, so we'll discuss future retail in a while with you in retail, but Shahina, your opening statement, do you like the retail space, and if yes, what do you like?
One cannot avoid being in the retail space as of now, given such a lot of news flows that are coming, especially in the M&A activity, etc. I think if really one is looking at the retail space, you can go in for the standalone like Trent, which in the sense it's like unlike let us say a Reliance, which is now talking with big players for its retail part of the business. So I think one can get into either of the formats. If you want to get into a safer play, Reliance is something you can really look at. But otherwise, on a standalone basis, I would go with the Trent. I believe the growth 20% plus has been pretty aggressive in terms of the new stores that they're planning to add. So they are getting aggressive. I would like to go in with a Trent if I'm to pick up one stock.
Okay, so that's the view that's coming in. We'll discuss all these stocks in detail. So Chintan, I'll start with you. You like Avenue Supermarts and you like future retail. What's your rationale behind betting on future retail?
Okay, so see the future group with the kind of M&A activities which it is coming up with. I mean, buying in Hypercity from Shoppers Stop, demerging one of their hometown channel. So there is a lot onto M&A activities which it has been doing, which is going to obviously create a lot of value unfolding in the future. Now talking about future retail, I'm betting very high onto it. Amazon coming into play, Google, Paytm coming into play. Paytm again backed by Alibaba and SoftBank for that matter, is going to really create a lot of value for this particular store. The synergy which I clearly see with future retail is very simple. One, it has got a physical store setup, so a brick and mortar spread across 255 odd cities and more than 1,000 odd retail outlets. They've got a footfall of approximately 500 million footfalls ideally in a year span of time. This brick and mortar model backed up with an online space will really create a lot of good synergies, and we very clearly project that with this synergy clocking in, the upside could be anywhere between 18 to probably 30% plus from here on.
Okay, and Avenue Supermarts, are you not concerned about the valuation, or you are okay with this valuation?
So again, valuation is just one of the factors until unless we see the value for investors really being generated. And that is one of the reasons, Avenue Supermarts trading at 140 kind of a P multiples as against future retail, which is, sub 70 kind of a P multiple. That's where the concern onto Avenue Supermart comes on the valuation front. And so the obvious bet is going to be future retail. But if you really have to be making a basket of, multiple counters, yes, Avenue Supermart will rightly fit in. The bet still is on the future retail at this point in time.
Okay, so future retail is the bet, and also Avenue Supermarts is something that Chintan likes. Vinit, it's a basket approach for you. So you spoke about counters like Trent, you spoke about Shoppers Stop. Which is the third counter you spoke about? V-Mart. So give us the rationales, one or two lines, why you like each, and also tell me which is the stock that you would avoid in this space.
Yeah. So I'll go with avoid first. Clearly, Avenue is a avoid for me.
Okay.
Because I think the valuations are prohibitively expensive.
Okay.
And its selling point has been that they were the cheapest. But I think Future is now selling cheaper than this. So the mass consumption will obviously go where the cheap products are available. That is one. Coming to the strategy of using a basket approach I've explained to you earlier. So I like V-Mart because they are clearly focused on B2 and B3 category of towns. They're growing very fast. They have a very high ROE, so they've got their model right. And in retail, what is happening is that fast fashion is playing out very aggressively. So the number of Chinese players who offer latest fashions at very affordable prices. So you're not facing competition from only the Indian brands or the retail stores out there. You're facing competition from this Chinese approach, and which has been growing very fast. It's already a $3 billion industry. So with this approach happening, I think when you're targeting the mass market for fashion, I think you have to go with where value is created. So V-Mart very well understands this market. That is number one. Number two, we are talking about Shoppers Stop. They've got a new CEO in place, and they're moving into the private label chain. Okay, so that is going to expand their margins a lot. And with the tie-up of Amazon, they're going to have the latest products available. So I like this company where there's a lot of potential available. I think on a FY20 estimates, it's available about 35 times. So, or maybe now it's gone up a bit. So I like that stock because of this strategy. And I am very, I've been to trend stores and I really like the way they are. They're at 90% private label. So they clearly understand the fashion market.
Okay.
And they've got EBITDA levels of 9% on a revenue base which is much lower than the other guys. So also same store growth is on a very brisk footing out there. So I think these three plays clearly are my ones to go with.
Okay, so that's the rationale that's coming in. And Shahina, what's your rationale for Trent? What are the key triggers that you think, and what do you make of the valuation?
One is, of course, they're reporting good set of numbers, 20% top line growth, EBITDA margins close to 12%. I think these are very good numbers. And the management commentary that we have heard in the recent past has been very aggressive. They're talking of 30 store addition in the next 1 year in FY19. Over and above that, I think there are certain negatives that were there. Like, for example, Zara was impacted by import duty on certain products. So I think there they are talking of passing it on. There are some of the other the star format, which the management is saying is a very doable format in the 5,000 to 8,000 square feet type of stores. So that is planned to be aggressively, they're planning a good growth in that. And lastly, the hypermarkets, which are actually now not making money, that is expected to break even. So all in all, I think Trent looks like a very decent bet for a long-term investor for 3 years.
Okay, so those are the stocks that's been spoken about in the retail space. I think all three of our guests are rather bullish on the entire retail space. So counters like Trent, there is Future Retail, there is Shoppers Stop, there is V-Mart Retail, and obviously one of our guests likes D-Mart, the second says it's an avoid. But the other counters are something that you need to watch out for. The third stock we want to talk about is we're asking our guest, since the market is moving and now again mid caps have started contributing, large caps are anyway moving. We're asking a guest to name one stock that they will buy at the current market price if they have to buy it right now, and probably not sell it for the next 2 or 3 years. So it's a longish, slightly longish term bet that we're asking him. So we'll ask them which that stock is, what is the reason, and what is the risk involved in taking such a decision. So Shahina, I'll start with you. Which stock do you like if someone was to take a, let's say, 3-year bet? If they have to buy it and hold it, no matter what happens, at this price, what would you bet on?
I would bet on the pharma sector, and which has actually shown a bit of consolidation and now on the up move. And in that, Sun Pharma. I think Sun Pharma, despite all the problems in the US, despite Taro not doing well and showing a negative growth, Sun Pharma reported a decent revenue growth on the overall business. EBITDA margins, I believe, while on a quarter-to-quarter basis was slightly weak, but if you look at it on a comparison with the last full year, I think it's shown a tremendous improvement at 22% EBITDA margins versus say 16-17%, which was reporting in a quarter or two back. So I think there seems to be stabilization on those fronts. And lastly, I think the resolution that's come about in Halol, I believe that will be a medium to longer term good positive, because you'll see new products, new approvals that are coming in over and above the products, specialty products that have already been talked of launching in the next 2 quarters. I think over the next 1-2 years, there will be a good flow of news flow as well as new products that will be launched, approvals that will come in. So I think valuations also reasonable. 25 times is not cheap, 22 to 25 times, but given the bad numbers as of now and the delta, the change, I expect to be much better over 2 to 3 years.
So are you seeing pricing pressures ease for pharma companies? Because the management in the con call said that pricing pressure will continue. So are you solely betting because it's already moved up significantly on Halol resolution? So the price movement has already come in there. Are you betting highly on the specialty pipeline, or what are you betting on that will drive growth for the company now?
It's all of them. Actually, specialty will actually, the new product launches in the medium term will support a growth in terms of revenue. EBITDA margins, while they were impacted, last year we saw, last 2 years we saw the big impact coming in for the US market in terms of the softening in margins. So I think there seems to be a stability that is set in. That is why I'm focusing on the EBITDA margin stabilizing over the last 2 quarters. So while I don't see a complete turnaround in terms of EBITDA margins moving up, I don't see too much of downside in the EBITDA margins. So to that extent there is stability. So on one hand we are seeing we expect a growth in revenues coming over the next 3 years because of resolution in the US FDA issues. On the other hand, you're seeing EBITDA margins sustain, and PE, which looks little high on the current numbers, which is actually much lower in terms of profitability that they have been doing in the last one couple of quarters, which was used to be historical 2-3 years back. So as we move back to those type of profitability and growth numbers, where there is a stability in terms of products that can be launched in the US because of resolution of US FDA issues, I think the company should start doing better.
Okay, so Sun Pharma is the first pick. Which one do you like, Chintan?
So, Darshan, when I have to identify a story that is for a longer term, I would rather, identify a counter which is very stable, very consistent in terms of generating wealth for the end consumer. What could be a better bet than any kind of a consumption story in India? So I would rather, vouch on Dabur India for that matter. The reasons being very simple. If you look at this particular counter, it has been stable, consistent in terms of delivering returns. When I look at the valuations, it is not as expensive as the other peers, like even Colgate-Palmolive for that. Colgate for that matter, even HUL for that matter. So Dabur happens to be, on the valuation front, it is good. 16% is a kind of a growth year on year for last 10 years, kind of a CAGR that it has delivered. That's one part of it. Second, return on the capital that has got invested, which is at 20%. So again, all these factors put together on the valuation front gives Dabur India a very good story. 46% is again kind of the dividend yield that the stock has been providing. So when it comes to creating wealth for the end consumer, I would rather bet for a longer term on a very stable going stock. Moreover, also when you talk about this particular counter, it's consistently increasing its product lines, the product variants, and largely focusing even on the Ayurvedas at this point in time. Rural consumption story is going to be playing a key factor in boosting up the entire volumes for Dabur India for that matter. So on a long-term basis, even if I have to hold in for forget about 3 years, but even for 5 years, this consumption story is something which is going to give me consistent growth, and I would still identify that the 16% kind of a growth that it has delivered year on year might be beaten with the new consumption variants which are coming into place.
Will they be able to meet the volume growth? They did 21% this time around on a low base. Will the volume growth story continue for the counter on a higher base?
Okay. See, 21% was delivered because the base was lower, right? We do not expect that it might continue with 21% kind of a volume growth, but as I say that even if the bottom line, right, forget about the top line, even if the bottom line is increasing by 16%, it clearly identifies that the volume growth will anywhere between 15 to 20% on a very consistent basis.
Okay, so Dabur is the second stock, and Vinit, I think you've spoken about Sterlite being your top pick for a while. Even at these levels, you would be bullish on it, and again, if you can say the rationale.
We all know the fiberization story. That's not something which is not known about. But what we don't understand is that the fiberization is a global phenomenon, and the last mile connectivity, having fiber in your home, is very aggressive. Okay, so on one side you have the fiber story, on the other side you have the fiber layout story. So you not only are laying out the fiber, apart from that, there's a lot of customization happening for software and hardware. So that area itself, the fiber, the secondary area, tertiary area around fiber, is it's about a $9 billion kind of global this thing pie. And Sterlite is pretty confident that they can deliver about between $3 to $4 billion in the next few years. They already have a 500 million order from the army where they're L1, right, the Navy. Okay, so this application story with a EBITDA margin of potential of about 14-15%, right now they're doing about 11%, will add to the fiber story, and this story will play out. The fiberization and the entire network relay story will play out over the next 5 to 7 years with I think they can easily do about 20% CAGR.
Okay, just two questions. I believe you all have official coverage on Sterlite. What's the target there, and are there any peer company, or is it the only company in India which does this, what it does?
So there are two things which differentiate Sterlite from the other players, and where we believe that increasingly they will get a greater market share. Number one is that they exactly know how to lay out a network. So they've done the network layout for Reliance. So they understand the network layout very well. And what happens in fiber layout In India, the life of the network is about 7 to 8 years, where globally it's about 25 years. The reason is that the splicing is not done properly. You don't maintain the network. You don't know how to do it. So what Sterlite does, it tells you which is the best app network to lay out and maintain it. So this kind of experience the other players do not have, and you have proof of concept when they've done it for Reliance. So what happens is that this story they can take out globally, and they're not an India play at all. They're a global play.
Okay.
So they're extremely well well diversified. So your 3, 4, 5G will play out globally and then play out in India.
Okay.
So I think that story will continue for the next 5 to 7 years.
And what's the target that you have on your?
So right now you have a target of about 450 odd, but I won't be surprised, as this auxiliary revenues we get more visibility on that the target will keep moving up.
Okay, so we have counters like Sun Pharma, Dabur, and Sterlite Tech, which are the positional calls. We're almost running out of time, so very quickly we'll ask them on the last stock. Very quickly, what's happening with RBL Bank? What's the reason for this rally?
So very simple. It's the private sector banking rollout is a no-brainer for very, very good managements. We have one of the best managements at RBL Bank. And we have proof of the pudding is in the way they have delivered the numbers. So we think the stock is good for another 15 to 20% run in the short run.
Okay, Chintan, quickly, we're running out of time, but your quick perspective on RBL Bank.
Okay, again, maintaining a strong sense, a bullish view onto RBL. The CASA improving by 27%, and even the NIMs, which is almost up by 46%, purely because the asset book is increased by almost 36 odd %. So both CASA and the the financial books increasing at the same time shows a very positive move. Moreover, giving a guidance of 30-35%, achieving it very closely and maintaining it for future for future quarter gives us a lot more confidence onto this particular point.
Okay, and finally, Shahina, your view on RBL Bank, what's causing the rally?
It's a thumbs up. I'm positive. I think there is M&A that will keep the private sector buzzing for a long time. In addition to that, as they have mentioned, my co-panelists, very strong growth, and I expected it to continue 35% plus, 35 to 40% in terms of top line and profitability over the next 2 to 3 years. And if you see in terms of valuation, the ROA is improving because of the contribution of higher yielding profitability, higher yielding assets that are coming into play. The credit card business is doing pretty well. So ROA is expected to increase from almost up to 1.5, 1.6%, which I think is pretty good.
Okay, so it's a consensus bullish call that's coming in on RBL Bank. We don't have time to take a follow-up question on this. But with that, it's a wrap on today's Hot Money. Shahina, thank you so much for coming. Chintan and Vinit, thank you so much for coming to the studio for this edition. Ask BQ comes up next. Stay tuned to Bloomberg.